communicate with me, then I will be, it is open on the right-hand side. So welcome everyone. Thank you very much for joining me. My name is Adam, and I will be your trader slash presenter slash analyst for today's session. I'm always curious as to, excuse me, I'm always curious as to any of you who've attended any of my previous sessions. So always good to do that. I also don't want to repeat the same stuff over and over again. Please communicate. Anything you want to tell me, just put it into the chat box. For some reason, I think I'm fighting off a cold. I just keep sneezing, so I apologize if I do sneeze. I will just mute my microphone. Hello, hello, hello. Okay, so I just realized now I need to just quickly log in and create a new one. At some point, I'll actually create my own live account and move some of my cash across into this. I like to test different brokers as well. So I'm just going to create one for the purposes of today's session. Bear with me. I'm going to go with, I like nice round numbers, and I'm going to go with, it's good to work on 1 to 50. And I'm just going to do that. Okay, so lower leverage is Australian dollars, US dollars. Okay, there we go. So lower leverage is a little bit safer. All right. All right. So often well, usually when I do these, I have a, I try to kind of create the foundations for the analysis so that you understand the logic behind what I do. I don't really want to keep repeating that, mainly, excuse me, because I don't want to bore you guys to death with it. But I know also aware that some of you are newer traders that are joining us, and you could benefit from that. So what I might do is arrange with Paul to do a separate webinar, which you could watch to get those, like a separate pre-recorded video, which will take you through the stuff. Then I could just go straight into the live analysis. So first of all, the other thing is, if there's something specific that you want me to have a look at, please put it into the box. I'm going to have a look at gold. I'm going to have a look at the major currencies. I'm going to have a look at crude oils. I'm going to have a look at the indices. But if you want me to have a look, for example, at Euro Swissy as an example, then yes, go for it. Just let me know. Just going to move my camera off screen here. So I'm speaking to you today from London in the United Kingdom, and it definitely feels like it's heading into winter. It's feeling very autumny, and we didn't really have much of a summer this year. The other thing that I wanted to take you through a little bit was a routine. So my opinion is that to achieve trading consistency, you need to be applying and understand a series of concepts. Okay, it's a whole lot of concepts. So for example, one example would be, what is an uptrend and why is it an uptrend? Why do we go at that? So I'm not going to go into huge detail here, but I want to illustrate my point. So an uptrend, for example, is when we have a series of high lows, higher highs. It's when the buyers are in control. But another way to think about it is it's when the momentum is to the upside. Now, it isn't always high lows, high highs. You could have price come back down to a previous low and carry on. This is important, ladies and gentlemen, because you can have a double bottom. And if you've ever heard any of the basic patterns, you know that double bottoms are seen as a bullish signal, as a potential turnaround point. And therefore, double bottom in an uptrend is also a bullish concept. It's, if anything, statistically, it's a safer type of setup. And so it's really important. We tend to put our stop losses behind what we refer to as either swing lows or swing highs or market structures. And market structures are very important for us to pay attention to. This is a market structure, okay? And it should be obvious, like it should stand out. If you find that it's difficult to, like, do I obsess about this low or this high? Don't stress about stuff. If it's really obvious, go for it. If it's very complicated or messy, then it really is either complicated or messy, so don't worry about it. Meaning if the price action is very choppy and it's difficult to distinguish what's going on, that could well be the case, or it could simply be lack of experience. So as you get more experience, you'll be able to read the noise, the messy parts a little bit better. But it is okay if something isn't obvious. This is really important. So if you're trying to do analysis on your own and you feel like you've done, for that particular session, you feel like, wow, I feel like I've done some really good analysis today, but then maybe on this chart, I'm not really sure. So you tend to sort of go, well, maybe my analysis isn't that good. No, there are some charts where the price action is a little bit more difficult to read because it's a little bit more messy. Okay, so just want to reiterate that. Like, for example, this is market structure. This level has held And the reason I know this is because I can kind of see where that kind of level is. Now, remember that when you draw in horizontal levels, when you draw in support resistance levels, you need to do them for you. Okay, your job is to learn to trust your ability to organize the information into price brackets effectively. Okay, that's what we do. Okay, price bracket. So that's your job. So you don't have to go overboard. You just have to make sure that you feel you have covered the major ones. And although history is important, we want to weight our history to the most recent stuff. So we don't want to obsess about this level here unless it becomes relevant. So it really only becomes relevant if we break through this. Then we need to look back. And how far you look back really depends on how far do you feel you need to look back to feel that you have identified the major levels. That's it. That's the answer to that question. Excuse me. So an uptrend, this is still an uptrend, even though we've pulled back to a previous level. And again, if I clear that up, the downtrend remains intact, even if we come up and test it. Like that happens. Tell you what, this, I don't know if you've ever seen this happen. So price is going down, price pulls back, you decide you want to sell here, you sell, and then price starts doing this. So you start panicking, you go, I've got a high low, it's changing into an uptrend. And then it comes up to here and it goes down. This is a double top within a downtrend. It happens. So we don't really worry about high lows until we really get a confirmed break, like a proper break. That's really important. So it's important. In this particular case, we did breach that level. We did, but we also, you can see that we've now ultimately stayed above it. So you would have been normal and you would have been forgiven if you saw price break below that level. You would have, because like the rule is you're not supposed to break the level. But in this case, you can see ultimately, it ultimately held up. Excuse me. So there are messy moments, and I would call this a messy moment. Okay, and even because it's forming a bit of a head and shoulder pattern. And so head and shoulder patterns actually have an incredibly high success rate. 83, the exact amount apparently is 83.04% of all head and shoulders are successful. They break out and they travel that far. So, but in this case, this would be one of the ones that's set up as a head and shoulders pattern and failed. That's okay. But it's one of those, the 83% is one of the 17%. That's okay. Right, so wanted to just start with clarifying a few of those things. So I've got the two screens, I'm busy looking at the two different things. So let's start, I want to start here with, we want to increase our chances of success in the coming week. And it's really healthy for us to think of a week at a time. So don't stress too much about, so for example, if you're hearing in the news or you are stuck on YouTube or you go down a rabbit hole where you hear, oh, they're going to look for that, they're looking for an alternative to the US dollar, or that you hear about BRICS countries, or you hear about inverted bond yields, all this kind of stuff that's very dramatic. So the first thing you have to do is you have to take a lot of that stuff with a pinch of salt. You really do. It's worth your while. It's going to make you go crazy, and it's very easy to lose your mind. Now, the next thing is, a lot of that stuff might have more meaning to an investor than to a trader. As for traders, we really only have to worry about what's going to happen this week. We don't need to worry about the other stuff. We really don't. Because first of all, when they talk about something that's going to happen, so when in the times that I have been, from when I started getting into this in 2008, 2009, they were talking about trade wars with China back in 2009. They were talking about Greece defaulting. There was a whole lot of stuff because it was post the global financial crisis. And like most of that stuff never happened. But I remember it impacting my trading. I was like, oh, wow, I've got to short the euro. I've got to do all this stuff, even if the euro was climbing or the dollar was strong. So it messes with your head. So the rule is, the number one rule is that if you have to choose between what you're hearing or reading in a forum or hearing in the media, hearing from someone who's a fundamental analyst who's talking about this stuff, and what you're seeing in the chart, if something is supposed to be bearish and it is bullish, if it's trending up or it's got big green bars, but you're hearing all this doom and gloom, you always go with the chart. because the chart is always the physical orders that are going through, the actual orders of people buying and selling, not the talk, not the talk. Talk is cheap. So that's actual buying and selling orders that are going in. And so you want to make sure you always go with that. It doesn't necessarily mean, I would say that a lot of the time the fundamental stuff doesn't necessarily come out. It doesn't necessarily happen. Sometimes it does, but as a general rule, I often find it's very drama, it's clickbait driven, it's really terrible stuff. There's one particular, I'm not going to mention what it is. Excuse me for a second. Like there's one particular YouTube channel that I kind of look at their stuff on occasion, but their titles are ridiculous. I actually went back throughout their whole history, going back to like 4 years ago when they started with normal stuff. They were analyzing stocks and they were doing a few things, but now in the last 2 years, it's just become housing crisis. The world is doomed. The USA is about to collapse. It's just insane amounts. And they're not the only people who do this. And then when you watch the video, it's not really like that, but the clickbaity and the doom and gloom and the titles and the headlines are just so insane. So don't let that stuff get in your head. As a trader, you are only concerned with what is going to happen next week, because 6 months from now, if the euro is climbing, you'll be buying euro dollar. All right, don't let the bigger picture stuff get stuck in your head. You know why? Because then you take away your stop loss, because you think, well, I know it's going up today, but I think that this thing is going to play out, so therefore I think it's going to go down. And then you wipe out your account. So don't do that. We look at very key things. You should always have a line in the sand where you say, if price goes that way, no matter how much it hurts, I'm going to exit that position because it's clearly not going in my favor. And that's a journey. There's a journey that you have to emotionally go on from when it's really hard for you to cut those losses, to feel that pain, to a point, believe it or not, where you mature as a trader, where you know that the cost of feeling that pain is only going to get worse. And therefore, as painful as it is now, you're going to be grateful that you pulled the plug. And out of 10 situations where you feel that pain, it might go back in your favor once or twice, but most of the time you're going to be right to exit a bad trade. So stop loss and risk management are crucial, but they exist because they actually prevent you from extremely big losses. So a 1 or 2% loss is a very different thing from a 20, 30% loss. You can't come back from that stuff, and it destroys your self-confidence and your will to live. And some people put all their money savings into it. So just don't break that rule. All right. So having explained the logic of where these price levels are and what we're going to do. So the next thing we want to do is, if we're currency trading, we want to get a sense of what is going on with the US dollar, what's going on with the euro, what's going on with the pound. And sometimes you can get an essence of it, but a really good way to do an analysis is to start with the majors. So I'm going to reorder the majors in the way that I would go and analyze them. Okay, so I'm going to put in euro dollar, pound dollar, Aussie dollar. I want my Kiwi dollar. Kiwi dollar. And then I'm going to do dollar yen, dollar Swissy, and dollar CAD, so that I can look at what I'm trying to do, obviously, is to get a sense of them from the perspective. I'm going to basically spend a little bit of time looking at one particular currency. I'm going to do, it's like a Rubik's Cube, where I'm going to look at the dollar from multiple angles, and then I'm going to look at the euro from multiple angles. This is a really good way to identify where are the strong trends, where are the safest, highest probability setups. Because what we're doing, guys, we're just identifying a market that has a very high probability of moving. And if that is the case, and then we engage in that market, the odds will be in our favor, right? That's what it really is. So when you deal with more experienced traders, they do all that stuff automatically. And I think sometimes we forget to break it down to you how we do that process. So let's start with euro dollar. Okay, so on the daily, we have a downtrend in place. We have a downtrend in place. I see that we are also sitting potentially at a bit of a level. Okay, so potentially. I prefer to kind of mark this. I would say that's a nice little level there. So let's just adjust it. And I would say that probably that is a better description of the level. I think that's a bit, where price connects with a level from both above and below, it's more significant. There's also a bit of a funny level in the middle here. So like it gets a little bit complicated, but there's a little bit of that in this as well. And I see that over here. Okay, it's not that visible over here. It's not that visible over here, but it is over there. So I'm just going to place that over here. And that's it. That's all I need for now. Okay, next up. Next up, we've had a series like this is clearly in a downtrend. Also, I've put on a 50 and a 20 moving average. The only reason for this is we don't need to overcomplicate it. Generally speaking, if price is above that 50-period moving average, generally it's bullish. If it's below it, it's generally bearish. The 20-period moving average is a really great place to identify possible entries into a nice trend. So when it's trending well, it often comes back to that 20-period moving average, and there's often good entries in there. So just what it's doing here is it's giving me a sense of, is price overextended? Is it bullish? Is it bearish? And so on and so forth. So you can see that it's reordered here. Plus we can see physically, we can see lower highs, lower lows, but we also need to keep an eye on where we are in terms of price. Okay, so next up, what do I see? I can see the price move down here, pull back up. We got a bearish trigger sort of setup. We also got an engulfing bearish candle, which would have been annoying because anyone who was potentially triggered in here would have then been stopped out, and then the price would have continued down. But we also see this. So price, we had a bearish candle here, another bearish candle here, and we had a bullish candle here and another bullish candle here. So what is going on here with these within these last four candles? We see a battle going on. We see a battle going on. And it's also location driven. It's also location. Look at where it is. If you really want to be pedantic and move this down to that level, then all of a sudden you have this. And again, if you go, well, I don't know where should my level be, actually both of the places I've shown you are both valid, but different traders might have picked one over the other. Some traders might have said, yeah, I'll put lines on both, and some would have said, no, I prefer this one. But you can see here price bounced off this level and is now trying to stay above that 0.630 level. It's trying. Does that mean we're going to reverse from here? No. Or how will we know? How will we know? Well, I'll know for sure when we break above that, and definitely when we break above that. So if we break above those, we're probably going to see a reversal to the upside. How far up we'll go, we don't think too far into the future. We'll just target here. We'll start with that. This is way more realistic. It's much more in tune. It's much more shorter term. You're getting a weekly analysis. I really want you to focus on what's the most likely scenario just in the coming week, excuse me, maybe in the next 2 weeks. So the next 5 to 10 days, okay, trading days. So that could happen. We could actually see something like this happen. It goes up again, then does another bounce, and then kind of turns around. So you could get a triple bottom, but this is trying to set up for a double bottom. A big clue, ladies and gentlemen, would be a big green solid bar that forms here on Monday or Tuesday this coming week. That would be a big double bottom signal. In addition to that, so that's just purely looking at the candlesticks. In addition to that, I would add a very reliable indicator. So whether you like to use, I'm going to use a momentum indicator. So what is a momentum indicator? A momentum indicator measures the speed of the market over time. Not price over time, but speed over time. So people have their favorites. There's MACD, RSI, Williams percent R, CCI, stochastic. So they're all kind of listed under here. So we go under indicators, you'll see a few here. So you've got MACD, momentum, CCI, ATR. There's a whole lot of them. They're very similar. I'm going to use the MACD. So I'm going to use the MACD here. I've just taken away the histogram. Histogram is a bit distracting for me. So what should be happening normally is I would be getting a potential move to the upside. So if I haven't, I'm just going to recap this. If I haven't mentioned this to you, these indicators are very reliable. They're not just a 50-50 or 60-40. They are, if they are used correctly, they are 75+% reliable. So basically what happens is a market is going sideways, so there's not really a lot happening. And then it breaks out. And usually because it's pent up all this energy, it accelerates really quickly. And the angle is quite steep. Then it does very shallow retracements. Then it starts doing slightly deeper retracements, and it doesn't move up as much. And it does a deeper retracement, and it doesn't move up as much. It does a deeper retracement, gets to this. So there's this shift in angle. Goes like this, very steep, and then it starts slowing down. So the logic is that when that momentum starts shifting, that possibly it's losing steam, and therefore something in its future, one of two things could potentially happen. It will go into consolidation, and after the consolidation, it can go both up or down, or it's going to change trend. Those are pretty much the only things it can do if it's exhausted. But if we are looking to buy, so we finally get this uptrend, we come across it. Our biggest fear, of course, is that we're going to get in at the end of the uptrend. We get in, and that's the very last move it does, and then it turns around. So one of the things you could do is as you get more experienced, you see this by eye. you see the shift, the drop in momentum, you can identify it. But in the beginning, as a newer trader, forget it. But you can use a momentum indicator to help you with this. So what happens is the MACD, the RSI, all of them would do this. They'd be going here, and then as soon as price breaks out, they start trending up. High lows, high highs. As soon as price starts losing steam, they start trending down. So they, in other words, the market, they lag behind price. So price is still producing higher highs, but the indicators, the market isn't moving as fast. The market here has, for this period of time, has only moved this far, but for this period of time, it moved that far. So in other words, it's saying for the same period of time here, compared to previously, you haven't moved as far, therefore you are slowing down, and therefore it starts getting weaker. It actually goes bearish. And this is divergence. So this is the best way to understand it. What's the best way to understand it? And the same on the way down. So price is going down, it breaks out, aggressively goes down, small retracements, then starts doing deeper retracements, and then it just loses steam. And so the indicator, the bearish indicator, would be going down and then start trending up in about this area. Okay, so here's a beautiful example of it. And RSI and then will normally perform relatively well. So let me just clear these and let's go back to this. Okay. So we start to get that kind of, here you can see, for example, price is going up and up and up, and now it started to trend lower. So it's very important. It's not an invitation to sell. It's not an invitation to take a position going the other way. What it is it's a caution sign. It's saying, look, this trend is getting a bit tight. Do you still want to buy? And so you reassess your risk when you do that. So the reason I bring this up is if we go down to the 4 hour, you can see that actually this has started to trend higher. We're starting to get higher lows on the MACD. Prices aggressively moved down. Now it's not, it's doing deeper retracements. It's starting to, the angle has started to shift. The 4 hour is losing steam. Does that mean that the euro is going to change trend or consolidate? It means it's probably at the very least is likely to consolidate. It's definitely taking a breather at this level. It could still keep going. It's unusual. We've never had 10 straight down weeks that I know of in the euro dollar. We've never had that. So something is up. Something is up. Don't worry about what it is. It doesn't matter what is causing it. It just matters that we acknowledge that something is up. Because if you start Googling it, you'll get Morgan Stanley and JP Morgan, and you'll get, Deutsche Bank, you'll get all these articles saying that this is why it is. Don't worry about that. We're very unlikely to switch away from the US dollar as a world reserve currency for the following reasons. That has to be the strongest economy and the strongest military has to do that. The US has got the strongest military by 10 million miles. They still have the strongest economy, right? So ignore that. The person who takes over, the country that takes over, has to take on the entire world's debts. That's really important. So you'd have to imagine that all the other countries in Europe and everything would have to decide that despite the military supremacy of the US, that they would want to go with another country or take on that burden. They've got to take on all the stress and strains of the world's debt. And that's insane to do if you don't have the strongest economy and you're not safe and you don't have a strong military, because then you become the primary target for people who oppose that kind of thing. So even though there's talk of China's economy being very strong, there's also a language difference. That means that all the English-speaking countries would now have to decide now in the next few years to, for no real good reason, to quit the US that's already in place. So in other words, think about the effort involved when people are lazy, and we've got all these other problems. We've got COVID and all kinds of other stuff. Now you want to add a whole other thing to that? Forget about it. So the countries aren't really willing to do that. They're not really willing to do that. So I would say, it's fair to say, unless something unforeseen happens, we're good on the US economy being the reserve currency for the next 10 to 20 years. So it's not going to change anytime soon. The BRICS, which is a series of other countries that want an alternative, which is fair, still don't want to be the reserve currency. But what they might do is create a secondary layer, in other words, an alternative option. But if it ever comes to where they're going to buy their military weapons from and all these kinds of things, they're still going to do trade with the US. They're still going to do it. They're not stupid. And if they get stuck and they need help, they're still going to ask the US for help. So I'm trying to kind of bring it down into what's likely. We're unlikely to change away from the US dollar anytime soon. And certainly the BRICS, if anything, would just give you an alternative option or a secondary option of trade. That's fine. But the two are and they're not incompatible. They're compatible. So don't stress about any of that stuff as well. Okay. cool. So the reason I mention that is because people are going, well, then that's why we're seeing what we're seeing. But I don't want to worry about that at this time. And every currency devalues. So when you hear about, oh, well, there's US currency, the US dollar devaluing, every currency devalues. Anytime a business wants to up its price because it wants to make more money, cumulatively, that is inflation. That's what inflation is. And everybody does it. It happens in every country, has always happened over time. So every currency around the world is currently devaluing. Okay. In fact, the US dollar right now is stronger than it has been for many, many years. It's very strong. So all of that stuff is just garbage. So just rule it out. You can see when you go to the dollar index, you can see it's super strong. So you can see that. And do we have inflation? Are these real problems? Yes. Is Russia a real problem? Yes, it is. Is COVID a problem? It is in some parts of the world. We have problems. We really do. But those are not the real things. Okay. But everybody is fighting to sell social, to sell content on that stuff. So don't get caught up in it. If it doesn't feel right, if it's not adding up, then don't really get sort of stuck on it. And also, if you're not seeing it in the charts, it's not happening. So because it creates a bias, then we make trading decisions that aren't based on what's actually happening in the market. I'm trying to spare you the pain that I went through for 2 years before I finally just started trusting price action. So I'm just mentioning this because it is coming in here. But right now, this becomes more dangerous to sell because the trend is not that strong. And actually, when would I start to go long? I would say if you really want to if I want to know if it's going to reverse, if we get a move above 107.50, 107.75, then I would think we're now likely to start. This is what's going to happen when your daily. So what happens is, when a daily chart is trending like this, while it's doing this, at some point, that weekly chart, so this is a daily chart, that weekly chart has become overextended. So here's your daily moving averages, and here's your weekly moving averages. So at some point, that weekly needs to do a retracement, which is usually when the daily goes into a temporary downtrend, and then goes back up, and then the weekly starts again. So when we see a change in daily trend, the very first thing that's actually happening, usually, is the weekly is starting a retracement. So we need we need time frame, we need a awareness of the context. So let's go look at the weekly. So we look at the weekly here, and you can see when you compare it, that was an uptrend of high lows, high highs. We've had a very big move to the downside. What did I say to you? And again, I'm just going to mention it. I'm not saying it's what's happening now, but if we move up from here, then that was a double bottom. However, I don't think that is the case here. This is a very long sustained move. I think we are here. I do think we're due for a bit of a retracement. We might come up here and then go down, or possibly back up here. So we might end up coming up to this, and then we form a bit of a head and shoulders pattern. Those are valid things. If there's something really big going on, because we had a very strong dollar last year, if something big is going on, we could have something like this. But even here, we had pullbacks. Even though that dollar was insanely strong, we still had pullbacks. So I think we should be able to see a bit of a retracement. The only question then really becomes, will it go down to here, or will it turn where it is here? Okay, I think that's really the case. And so I'm going to be watching that 4 hour to see if we do shift. And if we do a bit of a shift to the upside here, I'm going to treat it as a temporary weekly retracement at first. Because again, we're only worried about the next 1 weekly candle or the next 2 weekly candle. That's all we're worried about, guys. Bring it right down. Keep your focus in the now, making sure that's the focus. So we're seeing a weaker euro. We're seeing a stronger US dollar. Let's move on. Let's have a look at some of the other things as well, okay? Because I can never seem to do these in like 20, 30 minutes. And I hope you don't mind. I hope that you don't mind that mine are detailed and longer than average. I don't mind, but I hope you don't mind. So let's go ahead and have a look at sterling. Okay, so sterling is also incredibly weak. Broken this low. So we've definitely broken that uptrend, which means this uptrend is done. We have broken this low. We need to start looking at where are those kind of major levels. I would say this is the next major level. So I think early part of this week, we could still see it move a little bit lower, but possibly by the end of the week, if we get a weekly green candle on the euro dollar and GBP dollar, then I think it's highly likely we're going to, especially if the next week we break the high, we're going to see this go up. So this week is one of those weird weeks where there's a danger of it going in any direction. Usually I could say to you, well, you know what, we're not that overextended. It's very bearish. The next candle is most likely to go down as an example. But right now it's getting into a very tricky area. Aussie dollar is slightly different. Here you can see, I usually have a script that clears up all these lines. Let's just get rid of them. They're just too thick. So here you can see we're largely going sideways. We're in a nice little consolidation patch. We've got wicks at the top. What does that tell me? It tells me it's trying to push back up, but it can't. The dollar is very strong. So far out of Euro, GBP, and Aussie dollar, the dollar is definitely putting pressure on all of these, but there's a strong level over here. This coming week, if we break through this while we're going low on GBP and Euro dollar, then it's very likely that dollar is pushing through. Okay, it tells me where it's likely to go. And if it does push through, it could work its way down towards these lows. So it's worthwhile watching all of these different charts. Here you can see as well, Kiwi dollar also is trying to turn around. It's trying to produce that swing low. Actually, it's looking good. It's looking slightly stronger than the Euro, the pound, the Aussie. The Kiwi's looking really, really strong. To me, this looks as though at the very least it's going to work its way up to 0.6, but probably higher than that, 0.60550. So what do we see so far when we look at this? We're seeing the Kiwi is the strongest out of the Aussie, the pound, the Euro. And the Aussie is still strongest. The Aussie and the Kiwi are stronger than the Euro and the pound. The pound is the weakest because that's taking a hit, and the dollar is quite strong. So let's look at dollar yen. So dollar yen is climbing to the upside. Often that's the case. Now, another thing I'm going to throw in here from experience, Japanese yen, dollar yen, specifically dollar yen, not euro yen, not pound yen. Dollar yen does its own thing. The reason for this is very straightforward. They're an export country. They have their biggest client is the US, strongest trade relations with the US. They keep their economy stable by navigating the yen to the dollar. That's just what they do. And they invented the candlesticks. They know how to do it. They have phenomenal traders. They're capable of keeping it under control. And if they can't, then they throw in Bank of Japan, BOJ policies. So just understand that the dollar yen can do its own thing. So even though dollar Swiss and dollar CAD are going down, if there's a strong dollar, for example, or a weak dollar yen can still go up. They will do whatever they have to do to get their currency where it needs to go. And that they're unique in that respect. Switzerland tries to do it, but Switzerland doesn't know what they're doing. I think the Japanese are still warriors. They're not afraid of doing stuff that is calculated risk. The Swiss don't do calculated risk. They don't know what they're doing. So dollar Swissy shows a stronger dollar. Look at this. It's insane, but that makes sense. Also, dollar Swissy is not inversely correlated with the euro dollar. Okay, because the Swiss National Bank and the Euro banks, they're not that way. So although there are some correlations, it's not. If you go really compare them, you'll see Swissy does its own thing. And dollar CAD clearly is weakening anyway, because even though we've got a stronger dollar, we can see that the last couple of weeks, dollar CAD has come down. So dollar CAD stuck within a range. So you can see that there's more similarity between Euro, GBP, Aussie, and Kiwi against the US dollar than there is between dollar yen, dollar Swissy, and dollar CAD. And you should treat it that way. When you're seeing the same thing happen on dollar yen, dollar Swissy, dollar CAD, then that's important. When they're all going down together or going up together, that's the dollar that is driving it. When they're doing different things like they are right now, then their policies are probably competing or working with the US dollar. Meanwhile, the rest of the others will tend to not really have policies so much that work, because I think Euro, GBP zones do a lot of trade together. I think Aussie and Kiwi zones do a lot of trade together. So they tend to correlate more than just that. So that's okay. So we have a strong dollar. We also have a strong Kiwi, which means immediately, let's go look at the Kiwi pairs. So what is Kiwi CAD doing? Kiwi CAD is looking very nice and strong here. It's also got a bit of a level here. I think we're going to see Kiwi dollar push a little bit higher this coming week. Let's compare it. So let's look at Kiwi Swissy. Kiwi Swissy, very strong. Why? Well, because we're seeing the Swissy weak and we're seeing the Kiwi dollar strong. Kiwi yen, also very strong. So I think this coming week, I would certainly put the NZD charts on my watch list. I like them. I think they're going to be quite nice and strong. They're all going the same way. Let's compare the Aussie ones just out of interest. So let's look at Aussie CAD. Double bottom. Here's your beautiful double bottom. Why do I say that? You can see prices come down here. We've got a nice bullish, almost engulfing candle, and we've got bullish divergence. So if we just move this, you can see you've got bullish divergence. Very good. So those are really good signs. Normally, I think we're going to see Aussie CAD push to the upside. Aussie Swissy for sure. How do I know that? Because the Swissy, what do all the Swissies have in common? So when you look at CAD Swissy, it's climbing. When you look at Aussie Swissy, it's climbing. When you look at pound Swissy, it's probably climbing. The pound's so weak, it's neutralizing it. But Aussie, Kiwi Swissy, CAD Swissy, probably all of those are pushing them higher. Okay. Okay. So you can see the difference here. The pound is so weak. If we go look through the pound pairs, pound Aussie is dropping. Why? Because that Aussie is strong and the pound is weak. So that you can see it. So pound Aussie is going to be great Pound Kiwi is going to be insanely good. You might get some retracements, but they're going to be fantastic for those trading opportunities. Pound CAD going down. So the pound is very weak. Okay. Pound yen is probably messy. Oh, no, it's going down. Okay, so they'll either be messy or going down. So that means that if the euro is probably possibly a bit stronger, the euro Aussie's going to go down. I would say, so far the ones I love are the Kiwi crosses, strong trends to the upside. Kiwi's very strong. The pound is really weak. So pound Kiwi, pound Aussies, they're going to be fantastic trading opportunities. Does this make sense, everyone? Those crosses. What's happening with Euro CAD? Bottoming out, overextended, bottoming out. Euro Swissy climbing, because why Swissy? So there we go. So Euro Swissy to the upside. So actually Swissy pairs now to the upside will be looking good. So Kiwi pairs, Aussie pairs, Swissy pairs, looking very good. Let's compare the CAD pairs. So what about Aussie CAD? Okay, potential move to the upside, potential compared to Euro CAD. Trying to form a bottom here. Okay. Pound CAD. No. So there's nothing that really jumps out. Look at Kiwi CAD though. That'll be nice and bullish. So there's nothing that really jumps out when you look at the CAD crosses that looks obvious. Those are currencies. Let's go have a look at gold. Okay, so gold's a mess. It produces a lower high, but then a higher low, but then a lower high. So it's forming effectively, roughly. It's a very juvenile thing, but it's roughly doing this. Which way is it likely to go? Well, if you look at the weekly, I'm looking for either more bullish candles or more bearish signals. Slightly more bullish here, slightly more. They're both green, slightly higher. What about the monthly? It's a mess right now. And you can see actually when you frame it, it's stuck here, stuck in that range. So gold basically shouldn't, unless you are skilled as a day trader, I wouldn't be touching gold right now because it isn't going anywhere. When it breaks below here, it'll move. When it breaks out there, it's probably going to move. And it's got some battles. It's at historic highs, close to historic highs. And it's got levels. It's got $2,000, $2,000, $2,050. Okay. Let's look at crude oils. I had a script somewhere that cleans up all the objects for my scene. Let's just go into this one. Let's just do this one, and let's just do this, and you just go D. Excuse me. Change of seasons, always going to go. So here's crude oil. Okay, so we're at crude oil. So let's forgot about the monthly. The monthly is bullish. There's your level. So that was a double bottom if you want to argue that. It doesn't matter. We've also managed to break, I would say we've broken above this level. So there's definitely a level that we've broken through that. We're closing on the other side so far. We've got a few more levels to go. It's fine. We've got a few more to go. But I would say if you said to me, is this bearish? It's not. Okay, so sometimes looking at a chart isn't about what does it look like? It's what doesn't it look like? So it's why you can eliminate stuff. So actually, I'm going to come up with a saying called rule it out. Rule it out. So RIO. Rule it out, meaning make sure that if you have an idea that a market's going to go one way, also convince yourself that it's definitely not producing signs of going the other way. So what I know that it's come up to a major level and it's produced a doji. Okay. It's basically open and close are proximity, very close to each other. Dojis can precede a turning point. Could be a swing high. We're at a major level with a doji. We've had a move up. We've had a similar size move up. We could, if we break the low here, see a move back down to these levels. But the trend is still intact. It's an uptrend. High lows, high highs. So crude oil is bullish, but also needs to retrace. When we look at the daily, we haven't really come back to the 20. So we could have a situation like this, where it's coming back, then it's going to go up, but then it's going to do it. And this is a great example of a daily retracement being a weekly retracement. It's beautiful. It's a prime example of a daily trend within a weekly trend. Do you guys see that? Beautiful example. So whenever one time frame, starts a retracement, that's starts a change in trend. The higher time frame is usually starting a retracement. Excuse me. Wow, my nose is getting blocked very quickly. So I'm not going to keep you for much longer. So this is, I'm a little bit cautious about that. It is bullish, but it's had a big move up. I would really prefer for it to pull back into that area first. So I'm a little bit cautious here. I would say if we do come up and break this, and we're also at a major level. So actually now it's safer to either wait for a pullback to here or to wait for a breakthrough and get in on the breakout or get in on the pullback. Because we're right close to this major level. We're just like, it doesn't quite feel right to me. But yeah, if you're in on any of these trades, it's good. There's a swing low. Then we have the global indices. So let's work backwards from Australia quickly. Let's look at it on a monthly. We're sitting near all-time highs. Where's our major levels? We're sitting close to support level. Let's put a support level there. There's also a bit of a support level there. So we're sort of sitting in no man's land. Okay, we're range bound. How do we know this? Because you can see it. We haven't gone anywhere. So to say that the market is bearish or something now is not accurate enough. We're in a very dangerous area because we can find support anywhere in this area and we can ping pong back up here and we're right near these levels. So it's a very dangerous kind of choppy environment that we're in, and it tells you nothing about the overall status. To just remember that the index is made up of the best performing companies for the most part. In other words, it's meant to be made up of the winners, and the winners tend to win. So people shouldn't treat the index as equally made up of winners and losers. It's meant to be made up of winners, which means it's meant to go up over time. It's supposed to. It's meant to either take a break, maybe have a correction, but it's not meant to go down for years, long sustained periods of years. It's not supposed to do it. It's meant to go up because it's meant to be made up of the profitable companies that make money even during a recession. So don't let it get into your head that this is an accurate representation of everything. It's also not necessarily a representation of the economy. Yes, there are links, there are ties to it, but a market is made up of spare cash. It's literally made up of money that people have put in because they want to make more money than they would make putting it in a bank account for standard interest rate. That's it. That's where all that money comes from. Okay. Then we have, let's go to Hong Kong. Let's look at the Hang Seng. Hang Seng is a little bit weaker. Overall, this is more bearish, but this is not necessarily representative. And this is a monthly, so it's not necessarily representative of whatever else is going on. Then we have a look at Germany. So Germany right now has, and I'm a little bit cautious of this because the DAX has managed to just break up, but it definitely has bearish divergence, and it's battling at this level. So it's got this level here to contend with. So this is really what I'm looking for. I want to see this week if price manages to hold at this level or break down towards these levels. And again, it takes 3 to 6 months to go from a bull market to a bear market. So the fact that we have one down month is not the beginning of Armageddon. We don't do that. As a trader, we deal with it week by week by week. Just try to get into that habit because it'll keep you from jumping the gun on stuff that ultimately doesn't happen, because people then start shorting the market now, and then it just turns out that it's had a really big move. It just does a retracement and carries on up. And so when you let the stuff out there get into your head, it doesn't. So for example, when we talk about inverted bond yields, so for some of you, I don't expect you to know anything about this, but the idea is that it's not normal or common for shorter term bonds which are government backed. So you have stocks and bonds. Basically, I'm going to oversimplify it. Stocks are private companies that you put money into. Bonds are the government. So they're meant to be safer because they're backed by the central banks and so on and so forth. But you get lower interest, you make less money off them, but they're safer. So higher risk, higher return on stocks, lower risk, but lower return on bonds. Very simple, very straightforward concept. Then so the concern now is that you get 2-year, 5-year, 10-year bonds, for example. The 2-year bonds shouldn't necessarily be making more interest than the longer term bonds, but they are. Okay, I will be done in 3 minutes. Is that okay? 3 minutes? Tell me. Cool. So basically, the concern is that this is normally a good indicator of a recession. So yes, we could have a recession, but actually, there are situations in which it isn't. Basically, if the market is more interested, if interest rates are higher to curb inflation, bonds become attractive because they start making more money. So interest rates can be higher, but interest rates also don't necessarily mean you have a recession. Interest rates in the 80s were way higher than they are now. So So again, we've been used to very low interest rates, and therefore these feel very high, but they're the same as what we had prior in the 90s. Low interest rates are actually not normal historically. So just wanted to bring you up to that. So, but they are causing pressure. They are causing the interest, and people starting to look at bonds and so on and so forth. But it isn't doom and gloom. So let's just kind of maintain perspective. There are situations in which shorter term bond yields are not a precursor to a recession. Okay, finally, let's very quickly look at the UK. UK stuck at all-time highs. Very nice bullish candle so far. Very nice this month. Let's look at the NASDAQ. NASDAQ's had a big move up. It needs a retracement. If you use Fibonacci and you measure from the lows, for example, we have just had a 236. We could even go back to a 382. So this is just a retracement right now. We don't need to go doom and gloom. And historically, it's likely to go up. At most, I would expect it to potentially come back down to here. So we're still we've just gotten out of this bear market. We're back into a bull market. So a retracement is overdue. We need to have that. S&P 500, again, very nice, normal, natural breakouts of this level back to potentially retest it, possibly on a Fibonacci level. If you want to measure it from there to there, it's a 236. If you want to measure it from here, if you decide that's the higher low, you're at the 382. So we're in a really good area for this to turn around. So, and September historically is the worst month. Therefore, I think it's feasible that once we get through September, let's deal with October, but October is likely to be a bit of a green month. So yes, there's possible moves, continuation to the downside, but let's not big picture it. Let's keep it smaller, tighter, down to the next level. Let's deal with it. If it bounces and recovers, don't be surprised because we're on a bull market. Okay, but it might only do that in October because September's are historically the worst months. And that's where we are, ladies and gentlemen. So I think there's more opportunities, safe opportunities, relatively speaking, in crude oil and currency pairs in the coming week. And I hope that that made sense to you. Hopefully the key thing is that the way that I explained it to you made sense to you. Okay, guys, I'm going to leave you with this. And thank you so much, Sam, as well. And I want to wish you a wonderful week, guys. Trade carefully, trade sensibly. Don't get paranoid. Just stay calm, keep calm, and carry on trading. Okay. And thank you very much. I'm gonna exit.